Today, I am going to explain break-even points. Break-even point. Break-even point is a point where total revenue is equal to total cost, as a result no profit or loss. What does it mean? It means total revenue is equal to total expenses. So, no profit or loss in break-even point. Every business person must want to know his break-even point for his business. It is very important for decision making. We can calculate break-even point in term of sales or in units. It depend on requirement of the question or project. Let me explain each formula in details. Break-even sales, also known as break-even dollars. Both terms have same concepts. We calculate break-even point with the help of formula. Break-even dollars equal fixed costs plus desired profit divided by contribution margin ratio. In this formula, we need fixed cost and desired profit if available. Sometime desired profit is not available, then you may add 0 as a desired profit with fixed cost. Second point, contribution margin ratio, is calculate sale less variable cost, divided by sales. Note: in the calculation of the contribution ratio, we will use total amount for sales and variable costs, or unit price for sale and variable costs. But the contribution margin must be same. This point will clear in more details in example. Now you must note the formula at that time. Now we are going to learn break-even point in units. Sometime, in the product is required break-even hours, pound, or like other units. It is same thing. But famous break-even point in units term is used. In this formula, we need fixed cost and desired profit if available. Sometime desired profit is not available, then you may add 0 as a desired profit with fixed cost. Second point, unit sale price less unit variable cost. Note: sale price less unit variable cost is equal to unit contribution margin. Please write down these points in your notebook. It will help you in example explanations these concepts. Let me explain break-even point concept with the help of very simple problem. Let a company have $30,000 fixed cost, variable cost per unit $6 and sale price per unit $10. First, we will find our relevant data from this question. For the calculation of break-even point in a sale, we will need fixed cost, variable cost per unit and sale price per unit. First, we will find contribution margin ratio. For contribution margin ratio, we will subtract $10 sale price from $6 variable cost and divided by $10 sale price per unit and get 40% contribution margin. Now, we will divide $30,000 fixed cost to 40% contribution margin ratio. We will get $75,000 break-even sales. Now an important point you must note at that time. If we will divide $75,000 break-even sales to $10 sale price per unit, we will get 7,500 break-even units. Now I am going to explain break-even in unit concepts. Here, we need contribution margin in unit. For contribution margin in units, we will subtract $10 sale price from $6 variable cost and get $4 contribution margin. If we divide $30,000 fixed cost to $4 contribution margin, we get 7,500 break-even units. Once again, you must note important point here again. If we will multiply break-even units with the unit sale price, then we will easily calculate break-even in sales. This point mostly student missed in this topic. But you must know about this concept. Break-even point is based on few core assumptions. First assumption is that the price of a product or services remain constant as volume change. Second assumption is that the cost can be accurately split in variable cost and fixed cost. The variable cost remain constant per unit and fixed costs is constant in total over entire relevant range. 3. Sale mix remain constant in case of multiple products. I have explained multiple product break-even point in my other video. You may find in my Accounting Plus channel. The fourth point mostly student forget during exam time. Kindly note this point with full attention. The inventory don't change. It means number of unit produce equals the number of units sold.